Hey folks, and welcome to the Pipnotic Symposium for the 30th of March 2020. Today we're going to talk about risk-reward ratios. We're going to talk about statistical probabilities in relation to the outcome of any given trade, and then we're going to have a look at maybe a pair, do an analysis of a pair depending on how long the first bit takes. But I don't want to spend too much time today. I know you're all busy at home, babysitting, looking after kids, activating kids and stuff, and I'm as well. So I'll try and keep this short today. Okay, so let's assume that you have a trading system, and a trading system. Rather, before I go down that road, I just want to say, many years ago, when I was working within the IT security industry, we used to do a lot of work for lotteries, so national lotteries, and one of my primary contact persons, her husband was director for a casino, the biggest casino in one of the capitals in Scandinavia. And because of my relationship to my contact person, she asked if I could come down and spend an evening with her husband while he talked me through the process of maintaining an edge at the casino, because this is something that fascinated me. And so I went down to the casino, and I hung out with this guy, and he was a very interesting person. He was very open with me, and he told me many things that night, things that actually stuck with me. And one of the things that he told me, which was quite surprising, was that they invested a significant amount of money in ensuring the randomness of their roulette wheels. And they said without a high degree of randomness of each outcome of a spin of the roulette wheel, they could potentially lose money. And I thought to myself, well, how on earth are they making money then if they are dependent on a very high degree of entropy? And so I didn't know anything about roulette at the time, so I asked him about the rules of the roulette, and then he told me that you have the black and you have the red. And so this is kind of the 50-50, like, you have a coin flip, you flip the coin, it's a 50% probability that it'll land on black, and there's about a 50% probability that it's going to land on red. But there is an edge. There are other parts of the wheel that if the ball lands on that wheel, then the house wins. And so this is where the edge becomes visible. Okay, and I asked him, I said, when does this edge become visible? And he said, well, you have to ensure an incredibly high number of roulette wheel spins in order to visibly see the edge playing out. And it's a long time ago, I think he said about 4,000 to 5,000 spins. And after about 4,000 to 5,000 spins of the roulette wheel, then their edge would become visible. And this edge was between 3 and 5%, which is remarkable. Okay, so they're having 4,000 to 5,000 spins. I'm not sure how many times a roulette wheel spins during the course of a casino day, but I can imagine it's many, many times if they're busy. And so this edge becomes very visible very quickly. Okay, so this edge, this can be transferred directly to trading, where you have your edge. So you have your trading system, which gives you an edge. It can be supply and demand, it can be moving average crossover, it can be currency strength, it can be whatever. Okay, it can be overbought, oversold. Whatever. There are thousands of different kinds of edges that you can apply to a market to give you some kind of a perceived edge. Okay, and so when you have this, you just have to ensure that you have this sample size, which for them would be 4,000 to 5,000 spins. And I'm not sure what it would be for a trading system, but you would have to ensure that you were taking the trades over and over and over again. And so this leads me to the concept of fear. So let's assume now that you know your edge, you apply your edge, and you lose the trade. Okay, so you get up, you have a look, you say the edge is validating a trade, you take the trade, you take another loss, and then fear sets in. And then you say to yourself, oh, I don't know if I want to take this trade. Even though I'm supposed to be taking the trade, I'm not going to take it because the last two trades were losers, and so I'm not going to take this one. So you step aside, and you let the trade play out without engaging the market. Then you realize that trade would have actually been a winner. Imagine doing the same thing in the casino. Imagine my friend, he was at the casino, who was standing next to the roulette wheel, and he said, oh wow, we lost that spin, let's not take the next spin, because if we do, we could lose, because the last two spins were losers, and then that would potentially be the one that would have won. Okay, and so you have to see that if you have an edge, you have to apply the edge, and you can't interfere because of fear. Okay, because this is very, very detrimental to the probabilistic trading, the probabilities of of your edge playing out. Okay, so you need to apply this every single time. Every time a trade is qualified, you have to leave it. You have to let it play out. And I'm reading. I'm just about finished with a book by a remarkable individual, a gentleman named Jim Simmons, and he was the founder of a hedge fund in the US called Renaissance Technologies, and he's a mathematician, and all of the employees in his hedge fund were mathematicians typically. So they hired PhDs in mathematics, in physics, in all sorts of scientific fields, but they put incredible weight on mathematics. And he had a dream of creating a hedge fund that was 100% automated. There was absolutely zero human intervention. And all the signals, the probabilities, would be quantified using mathematics. And I thought that was beautiful, because if you consider what I just said about fear having a huge impact on whether or not people are going to be taking trades, if you remove human beings and you let computers do everything for you, well, then there's no fear. Computers don't experience fear. They'll see the edge, they'll apply it. They'll see the edge, they'll apply it. Even though there were 10 losses, on the 11th trade is going to take the trade, and that could very likely be the winner. Okay, so this is very interesting to me. Okay, and so you have an edge which gives you, let's say, a potential, let's say a 51 or 52% likelihood of the outcome of the trade being a profit. Okay, so that's pretty good. That's a pretty good edge. Okay, for the casino it was 5%, so they had a 3 to 5% edge that was visible over the course of about 4 to 5,000 trades. That's really good. Okay, and so I just wrote this very simple EA just to illustrate this. And the logic is random. I'm just going to show you what it looks like. Okay, so we have a random number, and this random number can be between 0 and about 33,000. Okay, so it's a random number. It can be anywhere between there. And then I'm doing a modulus 2, which is essentially scrutinizing this value. I'm dividing it by 2s, and if there's a leftover, then it's an odd number. If there's no leftover, so the result is 0, then it's an even number. Okay, so we have an even number, we have an odd number because we have 1, we have a result of 1. Okay, and so it's making completely random entry signals. And so I implemented here in this little in a small piece of software. I'm just going to run it here, and this is a risk reward of 1 to 1. Okay, so let's have a look at this. And before we look at the graph, I mean, let's consider what it might look like. Okay, remember again that the market has an edge. What is their edge? Their edge is commissions, and their edge is a spread. Okay, so they have that to their advantage. I don't have that to my advantage. So if I'm risking $1 for the potential of winning $1, I mean, you know that we're going to have a downward sloping graph. Okay, because each time I'm going to pay commissions and spread. Okay, and so that my broker is siphoning this out of my account each time I flip a coin. So if we have a look at the graph, we can pretty much expect to see something like this, where we have a gradual decline in the equity of my account. And if we run that again, I mean, it looks like this now. Next time it'll look different because it's random. So if we do that again, we go back, and it looks like this. Okay, so if we do this again, we do it once again, look at the graph, it looks different again. But the end result is we're losing money. You can see we're going to the end here, and this is a sample size of many trades. So if we have a look here at the report, okay, if we have short positions 1, 44%, long positions 1, 54%. So if you add those together, so 54 plus 44 is 98 plus the decimals. Okay, so that's not quite equal, but it's close. Okay, so let's do another one. Let's run through this and have a look at the report. We want to get something that's closer, and that's pretty poor as well. Here we have short positions 142, that's really poor. long positions 52. That's also good, but we're still missing a pretty high percentage. Okay, so let's try again. Go to the report. 44, 53. These are still pretty poor. Let's have a look. We need something that's close-ish. 46 and a 52. We're about 98. Not very good. We'll do one more. See, 44 and 53. Okay, so these, you can see that we're not doing very well because our edge is not in our favor. I mean, in this one here, we are 3.93% at a disadvantage. Okay, and in this one here, we are 3.83% at an advantage. Okay, so if you add those two together, we're close to 100, but we're not quite there. Okay, so we have a percentile disadvantage in contrast to our broker. Okay, so if we change this and say, sorry, my little one's screaming in the background, we put this to 2, we would expect two things to happen. The first thing is that we would have a slightly lesser degree of decay in our equity, and we will also have a slightly worse percentage of winners on both sides of the market, both long and short. So if we run that, let's do that. That wasn't very, yeah, this is what I'm looking for. So you're looking at something like this, where previously we would have a gradual decline in equity, so it'd slowly start moving down like this. But this one here, we have, I mean, we did lose, but we do have the hemorrhaging of equity is slowed down a little bit. We didn't go down to 0, but we went down to 50% of our account. So, okay, so this illustrates that we do have a slightly better situation in that I'm betting $1 for the probability or the likelihood, rather the possibility, not the likelihood or the probability, but the potential to win $2, which is going to bring our percentage of winners trades down. Short positions 1, now we're all the way down at 22%. Long positions 1, we're at 43%. If this is 43% on both sides, I think we'd be doing pretty nicely, but it's not. But you can see that changing the risk reward so that it's at an advantage for us, it slows down the money leaving our account. Okay, and this is a purely random algorithms we've seen here. This is completely random. We don't care if we're buying or selling. We just want to buy and sell completely randomly. And this is what this entry criteria is doing for us. So if we run this again, do a couple more times, we look at the report, 25% and 41%. So we're going to have an equity curve is pretty poor as well. You can see here, I mean, it's sideways. And when we started here, it went up, it went down, it went up, and it went down. But essentially, we're losing money. But in contrast to this, and we'll run it and compare the two. In contrast to this, it looks a little bit better. Okay, here we're just hemorrhaging money. We're losing money. Okay, and so this just illustrates very clearly that the likelihood of a coin flip, or the likelihood of an event occurring where there can be two possible outcomes to the event, head, tails, win, loss, these give us a 50% probability of the outcome being to our advantage. Okay, and I think that's pretty fascinating. Okay, let's have a look at something else here. If we have a look at this, let me just run this once again. Okay, so here we have, this is a coin flip, so we have like we have probability, number of heads. Okay, so here we have a very equal distribution in the number of heads and tails. So it's almost identical. Okay, so we have a 50% likelihood of it being tails and 50% likelihood of it being heads. Okay, and this is fascinating because this goes to show that when we do have an equal likelihood or probability of an outcome falling to our favor or to our disadvantage, then you need to apply other parameters. You need to focus on other parts of the trade in order to bring things to our advantage. Okay, and this is when applying an edge to the market makes perfect sense. And so you have to find your statistically your statistical edge over the market. This can be whatever moving averages, any one of the methods that we explained previously, or you can apply it to something else like risk management, money management, stuff like that. Okay, so anyway, a little bit of food for thought. Okay, let's have a look at the charts and see what's going on. Let's widen this. Let's have a look at the start of the Aussie and see what the Aussie's doing. Just going to move this down. I'm going to go to the monthly chart and see what's happening here. Okay, so if we have a look at this, this is all the data we have. We have a very big departure in price. Okay, so we had a very strong move. Let me plug in my pen. So we have, okay, so we have an origin of a move. Oops. Here, sorry. We have an origin move. It starts here. It goes all the way up to here. Price went up. And now it's moving down. Okay, where do we have deep pullbacks? Where's the deepest pullback since price left from this area here? It's right here. Oops. So I can do it straight. It's right there. Okay. So price came back to this area historically. And so if price is up here, we can expect price to go to at least this area here. And looking at this price structure here, we don't want to focus on anything here or anything here, because if you divide the chart up into our buy and sell side, here we have the sell side. Let's change the color for the buy side. Green. Let's do it from here to here. Well, then we want to be focusing on demand in this leg up here. Okay, so if we have a look at that, notice that we have the beginning of the buy zone, which is here, but notice that we also have other buy zones. When we have this area of demand, just here, you can see the white candle, the buy zone is there, price tore through it. Obviously, this is like kind of the recession kicking in, this coronavirus, kind of the catalyst of this, of these huge price swings, this high volatility. Notice that price went down here, and if you look at this here, let's zoom in a little and have a look. So you can see here we had this here. Okay, price tested it once, tested it twice, and we came up. So we had this area of accumulation. We had two candles. Price moved above this high here and above this high here. The origin of the move is around here. I'm just going to mark off a couple of areas. So we've got this one here. You know, I'm going to use, just going to delete this one. I'm going to use this line here. So we have this one here because this is where the slingshot was pulled back before it left. We have another slingshot which is positioned just here. And this is an interesting one because this is just a very clear swing. How price came down, we managed to come up here, we moved above this high, we poked into this supply, the slingshot was pulled back, and then we went north. And this slingshot being pulled back to here is responsible for removing this. And this is essentially in the leg that moved up to these all-time highs. So if we mark off that area here from the high, first the low of the slingshot here to the low here, we'll probably find that, and this is pretty clearly obviously where price went to. So if we go like that and zoom out, yeah, and you can see, I mean, this one's gone now. This is pretty clearly where price went to. Price went into this area here, the slingshot of the first one, then we had a bounce. And if you go to the weekly chart and have a look, let's have a look exactly where price went to. Okay, and then we'll scroll back and have a look and see what that looked like just here. Zoom in. Okay, so we have price coming up, we have a high, we have a low, we have accumulation, and then we have a period of accumulation. We have this here. Oops, there it is. Notice that we had this whole little structure here, how price went up, we moved sideways, and then price left. I mean, the lowest pullback just prior to the departure is here. Okay, and this is simply resistance becoming support, and then price left. Okay, so this is the slingshot being pulled back and price departing north, and this is pretty close to where price came to. If we have a look, yeah, it came right to it here, and it looks like magic, and it really isn't. It's a furthest thing from magic. It's simply an analysis of, let's see if I can find it again, it's simply an analysis of how price reacts to the beginning of the buy and the beginning of the sell zone, this being a very good example of the beginning of a buy zone. So we actually have three areas of value here. We have this one here, and we have the one above it, and we have the one above that, just here. Okay, and so price just poked into the middle one here. So we had a child. This is a child because this is created as a result of this. Okay, so price kind of moving away from these lows here. We moved up, we established like a new dealing range. Price moved higher, a new dealing range. So this is also telling us that there's an interest, people are interested, people are okay with buying at higher prices. So when you see this and then price pops out like we saw just here, and this is telling us that we have some pretty interesting price sensitive areas at this price window just here. Okay, so we also have pancakes here. So we have pancakes here, all throughout here. We have another plate just below it, and we have another plate just below that. Okay, and so this is really interesting to us, and this is stuff that we should really be paying attention to. Okay, cool. Let's remove all of this, and let's have a look at something else. Let's have a look at the Australian dollar. Actually, let's have a look at the euro. So what's the euro doing? Well, here, looking at the monthly, you can see that we have, let's have a close look here. We have this one here, how this candle closed above the highs of this. The body of this is in the range of the previous, the body of this is in the range of the previous. So these are all linked together. Here we have massive ranges, massive dealing ranges here. But we do have this one here, which is nested within this monthly area just below, which just disappeared. It's because I don't have enough data in my chart. If I go like this, I go back and it'll come back. And there it is. It's just because it's not showing it because the data disappeared. But we had this here, price kind of poked into this area and then price left. So if we look at this just here, this is kind of the beginning of the buy zone here on the monthly chart, and these are really wide. These are very wide. So price poked into it and then we left. Okay, so what does that mean? Well, that means that next time price comes back to that area, I mean, you don't want to be buying there. You want to be buying at the very best, at the most expensive price, which would be the deepest retracement since that. Or you go to the smaller time frame and you identify these micro areas that are going to be located below. Okay, and if you look here, if we go like this, you can see we have kind of something similar going on as we had earlier, where we had slingshot. Let's pull back to here. We have another slingshot that was pulled back to here. Let's have a look at this one where we had okay, this candle here moved outside the body of this candle. The close of this candle was above the range of that, and so we'd probably do something like this. You could focus on the bottom here like so we have something towards the bottom. Or if you go to a smaller time frame, you'll probably see something that looks a little bit clearer. Okay, here we are, where we have similar things going on. Okay, where we had this one here. First of all, we have to find areas that have been respected historically. So we had this area here, and notice here that, I mean, price had a tough time coming through here, there, and there. So we'll go like that, tested. Price went through, but we didn't hold. This is the pullback that price had to come to before releasing. And so price, this is going to be the most expensive price you want to pay. And then price came a little bit lower. Okay, price, we moved through the area. The area that did it is this one here. This is the slingshot. So this is beginning of the buy zone for this area of demand here. So this is one it's choosing. So it looks something like this. So if we remove this one, remove this one, and this one, because this one's gone, and we have this one here. Okay, and beyond that, we have the pullback. The slingshot was pulled back to here. So if we go and see where price reacted, it's probably close to that area. Let's go to the weekly chart. Now we didn't quite get there. We came very close to the weekly area. Oops. Which is this one here, which is, I mean, this is the area, this is a child area that tested this area of this older sibling. Okay, so here we have the parent, we have a child, and we have a younger child here. Okay, so this is established as a result of that, and this is established as a result of that. So price went up, slingshot was pulled back, price went higher. We didn't manage to move above these highs. We had to drive price lower before we started to attract some buying, and then we saw that, and you can see here how price gapped higher. Okay, and so this is where price came to. Price was happy going down to this area here, and if you look at this one here, notice that we had one period of accumulation. Okay, so the candle that left this one here, so the close of this candle is the body of this candle is not the range of the previous. The body of this is within the range of the previous. So you could mark it off like this from the low to the low here. I mean, you could just do this, so you make sure you get the whole area in. And this is where the price came to roughly. We still didn't get there. So, but you can see, I mean, how powerful these areas are, and they're pretty simple to find. It's very important that you don't overcomplicate things because it's easy to do so. So if you're looking at something that's not making sense, just try and look at something else. Okay, and if we look to the upside here, I mean, now you're asking me, where's price going to go to? I mean, that's a really good question. You think like, well, where is price going to go to? And no one knows. But notice also that, I mean, this here we have pretty efficient trading. How price comes, it leaves, it deviates from the mean, it returns to it. We leave, we come back. We leave, we come back. So price is relatively well balanced. And notice we had a pretty interesting. This is probably one of the most significant pullbacks. Since here we had a couple of them. We had this one and we had this one, and the origins indicated would have highlighted these for us, but price pulled back to this one and then it left. Price came back to this one and then we moved below this one, and we actually moved below this area of demand, which was tested a couple of times. Price moved through that. So the area of supply that removed this demand here, well, there's something up in here. We won't go down and have a look, but you can see pretty clearly that there's something up in here, because we had this area. Let's just box off the whole area. Move this line, test. We still didn't manage to go through, but when price was pulled back to this area here, this is where we attracted selling pressure that was strong enough to move price below this area of weekly demand. Okay, and so price came back to that pullback, which is the beginning of the sell zone, and this is where we found resistance. We onboarded some sellers, and then price retreated and moved back down to the opposing side of the market, which was this area just down here. Cool, well, I'm going to leave it at that. I hope you found this interesting. If you have any questions, please post them in the video below, or leave them in our Discord channel if you're in there. And if you want to receive updates when we post videos, then be sure to subscribe to the channel and click on the notifications button. Thanks for watching.